Hello, this is Michael Ball, Managing Director with Weatherstone Capital Management, and this is our market outlook and update as of July 2022. Those are the things that we're going to cover today. We'll talk briefly about the new Weatherstone logo. Then we'll jump into looking at the challenging first 6 months that we've seen in the financial markets. And then after we've covered that, we'll take a look at what things look like currently in terms of the valuation picture, the risks for a recession, where inflation stands, and then an overview of some of the changes in the positioning that we have had and that we currently have for both fixed income and equity in our tactical portfolios. As we get ready to take a look at what's happened in the stock market for the first 6 months of the year, let me briefly point out that if you look at the Weatherstone logo in the bottom right hand of the slides, it's changed from what you've been used to seeing for the past 10 plus years. We took and refreshed the logo to take and incorporate some of the elements of our parent company, Transform Wealth, in terms of how their styling and things look. So we wanted to, update and refresh to bring that more in line with what the parent company logo looked like. As we take a look at what financial markets have done during the first 6 months of the year, this chart provides a pretty interesting picture in terms of showing both where things stand currently during the year and where things have typically fluctuated in terms of drawdowns during the course of the year. So the gray bars are showing the full year returns, and then the red dots are basically showing the maximum decline that we've had during the course of the year. If we look at the current year, if we were to close it out right here, going back to 1980, this would be the fourth lowest return during that time frame. We're also still pretty close to the low for the year, and based upon the low that we've returned, that would be the sixth biggest intra-year decline that we've seen. Obviously, this shows what a challenging year we've been having so far for stocks, with the headwinds from inflation and potentially slowing economy. Particularly challenging year is that's also been very difficult for bonds due to inflation being hotter and more entrenched than what the Federal Reserve policymakers had expected. The year-to-date returns for bonds have been more than 3 times worse than any prior full year going back to 1980. Also, if we look at the maximum decline, that's also been significantly worse than we've seen as we're looking at the Bloomberg U.S. Aggregate Bond Index, which is the largest and most common bond index that investors will use and measure bond portfolios against. Where do we stand in relation to prior bear markets? And what does it take to regain new highs in the stock market based upon where things stand currently? We'll take a look at the snapshot as of the end of June. And as shown on the right-hand side of the chart, the stock market has dropped enough to reach a standard definition of being a bear market, as measured by a decline of 20% or more from a market peak. The table lists the bear market since the mid-1920s. As noted, the average decline has been around 40% over the full time frame, but that takes into account some very deep declines during the Great Depression. The average bear market since the end of World War II has seen a decline of about 35%, and the average bear market declines lasted about 13 and a half months. This current decline is currently not as deep and not as long as the average bear market has been. However, it is in line with bear markets that did not have a recession, which is why the question of whether we're likely to have a recession or not is quite important. We'll take a close look at recessions after we take a quick look at valuations. One challenge that we have seen for stocks in recent years is their tendency to sell at premium valuations. The decline in stocks this year has brought valuations back to more reasonable levels. As shown on this chart, we're currently slightly below the average valuation level for the past 25 years. Historically, we can see wide swings in where the valuation of stocks have been, and it typically fluctuates in response to investors' outlooks for the economy and things like that. With time periods where there's a great deal of uncertainty, such as during the global financial crisis, leading to very low valuations, and periods of high optimism, such as the late 1990s, and last year when the prices of all assets were going up, leading to premium valuations. It'll be interesting to see where the valuation decline in the current environment stops, but it's good to know that valuation levels have come back to more historically normal levels, and more negative scenarios are getting priced into the potential risk for stocks. Best ways to see how concerns about inflation and interest rates is impacting consumers and increasing or decreasing the likelihood of a recession is to look at the Consumer Sentiment Index, which has been a survey done by the University of Michigan since the early 1970s and comes out monthly. This measure shows some interesting insights for both the stock market and the economy. First, when sentiment has been at very low levels, particularly when it drops below a reading of 60, there's a high probability that we are either in or near a recession. The other interesting fact with this measure is that it tends to be a bit of a contrary indicator, showing that when consumers are very optimistic, returns for stocks tend to be below average for the next year. If it's very low, then returns over the next year tend to be above average, as can be shown in the box in the upper left-hand side. And so we go back and look and see historically when there's been a peak in terms of maximum consumer optimism, returns over the next year have been below average, about a plus 4%. If we're at a point where there's been very low sentiment and then it starts to peak and turn around, the return for stocks has been much higher at an average of nearly 25% per year. Now to inflation. As we're all well aware, inflation has now become the primary driver of what's impacting the financial markets this year, taking over from COVID. This chart shows both the traditional inflation measure and the core inflation measure, which drops out the impact of food and energy, which tends to be more volatile in the short term. Both of these measures are at their highest levels since the late 1970s and early 1980s. Last year, the Federal Reserve was indicating that they thought the jump in inflation would be transitory and would quickly come back down. Not only is it not quickly coming down, it's continuing to trend higher, and sustained high levels of inflation can have a significant impact on investor psychology and increase recession risk and negatively impact valuations as there's more uncertainty over predictability for earnings growth and things of that nature in the future. We look at whether inflation is likely to roll over in the near term. It's helpful to look at measures that either tend to adjust quickly and compare it with some of those that adjust more slowly. Energy prices are one area that can adjust quite quickly, and that has begun to cool down. And so one could argue that we're likely to see inflation peaking or peaking in the very near term. Some of the other areas as shown by this chart are used vehicle prices that tend to adjust much more quickly. But when we look at some of the other areas that tend to be a bit more sticky, as they often term it, we look at items such as housing, and particularly when we look at the way in which the Federal Reserve looks at the impact of rent increases and housing increases, it tends to take a while to work its way through. It's been showing that housing inflation has been running fairly slowly and is only now picking that up. Yet when we look at what's been going on in the housing market, we know that that's gone up quite significantly here over the past couple of years. So based upon the mix of factors, it's unlikely that we're going to be able to get back to a 2% target rate for quite some time unless we have a significant decline in demand, which would be unlikely unless we were to have a recession. If we look at the impact that the inflation spike is having on bonds, we can see in this chart that even though yields on bonds have moved higher over the past few months, which in this chart is the blue line showing the yield on 10-year U.S. government bonds, when we look at it comparing what we're earning after the impact of inflation, we're still at one of the worst levels in decades. In my opinion, this is one of the most important trends to watch in the coming months. If inflation begins to stabilize and bond yields also stabilize and that gap begins to move back to more normal levels, that would be a positive for both the economy and the financial markets. If, on the other hand, we begin to move back to more normal levels because bond yields have continued to move higher, while interest rates either stabilize or move higher on a more modest basis, this would tend to be quite negative for the economy and the financial markets, as it's likely showing that investors no longer believe that inflation is going to get back to the target levels of close to 2% for quite some time. and as a result are refusing to buy bonds unless there's a much larger inflation premium built into them. This would result in significantly higher debt cost burdens and would weigh heavily on the economy, both for individuals and businesses, and would significantly increase the odds of a recession and a slow economic recovery. The increase in interest rates that we've seen this year has impacted every area of the bond market. And as the table on the left-hand side shows, every area of the bond market is negative at the midpoint of the year. Areas that we've favored, such as leveraged bank loans and municipal bonds, are down less than most areas, but even they are down by several percentage points. So as a result, we felt quite comfortably holding above average amounts of cash, even though it pays us very little because the increase in interest rates has been quick enough and from such low levels that it's had a negative impact so far on every corner of the bond market. And if we look outside of the US, the picture has typically been even worse, both because of the increase in interest rates that's been global in scope and because we've seen a strengthening US dollar that's further detracted from returns from investing outside of the United States. So staying inside the United States and staying conservative and leaning towards cash has been the most conservative and the best position so far for protecting principal. Benefit from this weakness in bonds is that yields have increased significantly in virtually every bond asset class. This chart shows where the current yields, as signified by the dark diamond, stand in relation to the average yield over the past 10 years, as shown by the purple bar. And then the gray bar that's taller basically shows where the yield range has been over the past 10 years. When we reallocate out of cash and back into bonds, we anticipate picking up significantly higher yields than we were able to earn just a few months ago. If we can get the higher yields and stability in bond prices, it will become a much more positive environment for our fixed income portfolios during the remainder of the year. Look at how we are positioning things inside of our tactical investment portfolios. During most of the second quarter, we continued to favor cash over bonds. There was a short period in which we did move some money into the bond markets, but we had to reverse that as stronger than expected inflation numbers came out, and we brought that back to being quite conservative. As of the end of the quarter, we ended primarily with cash and then floating rate bonds. And as we have moved into the early portion of the third quarter, we've started to see increasing signs that bond investors are looking through the short-term interest rate increases, and as they see recession risks picking up, we're starting to see more stability in higher quality bonds. And as a result, we have allocated money into that area over the last week or so in anticipation that as we get more data out and it may show that we're moving closer or into a recession, that the Federal Reserve may begin to slow down their pace of interest rate increases or put them on hold until we have better clarity on how much weakness we're going to get out of the economy based upon the interest rate hikes that we've seen so far. We do believe that there's going to be some very good opportunities to buy bonds that are economically sensitive later in the year, but we're cautious towards them for the time being. It's certainly been a pretty interesting and volatile year in bonds, but we've been quite pleased overall with how we have navigated through that. As we look at how we're positioning inside of our equity portfolios, our short-term risk measurement models have continued to be mostly negative during the second quarter. And as a result, we have held above average amounts of cash, and where we are invested in stocks, much of that has been focused towards more defensive sectors or utilizing funds that incorporate buffers or other ways in which we can minimize some of the downside risk. We've also reduced commodity exposure in recent weeks as we've seen our model there turn more negative, and we have concerns about whether commodities continue to perform well if we do have a recession. We do see that recession risks are continuing to increase, And stock market declines or stock market bear declines tend to be deeper when you have a recession rather than when you don't have one. And so our maximum decline so far in the stock market has been about 24%. If we were to see a recession, then historically we're going to be closer to a 35 or 40% normal decline in that environment. So it is one of the things that's keeping us quite cautious towards stocks at this time as well. Our favorite sectors are hedged exchange traded funds, consumer staples, biotechnology, and then cash. And that brings us to the end of our overview of what's going on currently. As mentioned earlier, we continue to see the risks from above average inflation and then the Federal Reserve's response to it as being the biggest risk to the stock market going forward. In the current environment, our tactical portfolios are positioned quite defensively, both for bonds and for stocks. And our primary focus right now is on preserving capital and to have cash available for attractive buying opportunities in the future. And to step back and take a broader look at this cycle between bull and bear markets, when we hit the bottom of a bear market, typically that's going to be the point of maximum pessimism. We have several indicators that suggest that we may be getting close to that. And if we do, then we have some very good buying opportunities that are likely to be coming up in the coming months. With that, we'll see how that unfolds for us over the coming quarters and what happens with interest rates and inflation, and let you know the adjustments that we've made. Thanks for taking the time to listen, and have a good day.